Greetings, my friend.
Howdy, Delroy. How are you doing?
I'm great. I'm great. I'm great. You know, I have a choice. Before I bring you in officially, I can say something. The biggest investment launch that took place in a long while that attracted the Minister of Finance was done on Friday at the AC Hotel. I might say something more about it because tonight is bonds night. So let me bring you in officially. Bring me. All right. Money we're looking from bonds, Dan. Is there money to be made from bonds? But first, thanks for coming again the second time around as our guest co-host. Just tell us who you are, Dan.
Sure, my pleasure. Thanks for having me, Delroy. I'm the Senior Vice President of Investment Banking at Mayberry Investments Limited.
Right. Now, is qualified to tell you about which bonds to buy because I got a DM asking me which bond is Mayberry recommended. And I said, I can't answer that. Dan will be on and you can ask him. And I was told, good evening, Jamaics. Welcome back, Jamaics, Sanjay. So I was told that I am shy to put my questions out there, but please ask for me. So I'm not sure if you can describe what is a bond first and then what you're recommending. I'm not too sure. So that's one question. And I have another 4. Okay.
Great. Well, let's start with explaining what the bonds are, first as a matter of principle. And in general, whenever we're speaking to folks about investing, I generally say there are 3 or 4 asset classes that you want to invest in. One, obviously, is the one for which Mayberry is known as IPO King, stocks or equity. So
yes.
We're big fans of stocks and equities, and I think anybody who's building any kind of serious investment portfolio, you want to have equities in that portfolio. It's the best performing asset class, in my view, by far. Second thing you want to have in your investment portfolio is real estate. And by real estate, I mean investment properties. The house you live in isn't necessarily an investment. You know what I mean? It's not necessarily making income for you, but still, it's a good thing to own. Real estate. You want to have real estate in your investment portfolio.
Dan, I have to ask a question and I'm going to tell you why.
Yes.
Should you have an investment advisor like yourself when someone said, I see a property and I want it as investment property? Should they take someone like you along and I'm going to tell you why? Should they?
Yeah, I think it's a good idea to have a good realtor or your trusted investment advisor because yes, absolutely, or at least agree to concepts and principles with your trusted investment advisor. Absolutely.
Well, I was shown, someone told me the other day that they were looking at a downstairs apartment. I'm being serious now, no joke, because MoneyMatters family have to know. When I went to the place, I thought there was a difference between a basement and a downstairs. So you go through under some valley and whatever within the building, and I'm saying, where is the place? And I said, that can't be for investment because you can't rent that. I know that for a fact. So it seemed like the property was built and somebody just said, you know what? Let me just bounce out down here and just turn it into something like an apartment selling for about $16 million. I couldn't believe it. Yeah. And right there and then I said, I am not qualified to speak to the person on it. So I want you to say whether they should have, or as you said, a trusted realtor. A trusted.
Yeah. Absolutely. When you're investing in real estate, you need to have a trusted realtor who can speak to what you can rent this property back for, show you comparables to convince you that this thing is actually worth buying. And then when you do your math on it to make sure that the return that you're likely to get from that property, that it makes sense relative to other opportunities out there. Because the thing about real estate is you can't buy, $100,000 worth of real estate or $1 million worth of real estate, but you can buy the next best option that I'm going to bring you to, which is bonds. So again, after you have equities in your portfolio, you have some real estate, then the next thing you want to have in your portfolio are bonds. And typically you start with the equities and the bonds in your journey before you get to the real estate. Because like I said, you can't buy $1 million worth of real estate necessarily. So you start with your portfolio with equities and bonds, and eventually when you get to a certain target or a certain level, you may decide that, okay, now I'm going to liquidate some of these assets to move into this new asset class called real estate. Or like me, you get to a point where the equities are so big and the unrealized gains are so large that I say, let me take off a little so I can buy an apartment and put down for my as an investment property. So I started with the equities. When the money got really big, then I started buying some real estate out of it. But tonight we're going to talk about the bonds. So when I'm dealing with large clients, large pension funds, etc., I usually say to them, you want to have about 40% of your net worth in equities. You want to have about 40% in real estate, and then you want to have the other 20%, in my view, in bonds. I think that's usually a pretty good mix for when you're a mature investor down the path and your portfolio has gotten rather large and you think of these three main asset classes as the way to go. But as a young investor, as I said, you may start building with the equities and the bonds first until you build up to get to the real estate eventually, yeah? So I think when you're getting going, in that case, you want to have maybe equal portfolio of equities and bonds. So when you're buying bonds, which are fixed income instruments for the most part, you have a few options that you need to think of. Do I want to invest in Jamaican dollar bonds, or do I want to invest in US dollar bonds?
Oh, so you have different currency bonds.
You have different currency bonds, exactly. And I personally, again, for the young investor, would be encouraging them to invest in the US dollar denominated bonds, because those bonds do two things for you. It gives you the interest income, that fixed income that you're looking for, plus it gives you that growth, sadly, sad to say, from the devaluation of the Jamaican dollar. So one thing you can bank on, that is for sure, is that unfortunately our exchange rate will always be devaluing. So as an investor, you want to take advantage of that and invest your money where possible in US dollar denominated bonds. Because as sure as night follows day, unfortunately, our currency will continue to devalue.
But Dan, by the time you finish, there is a comment that said bond is a joke for small investors. But I just heard you saying that you can buy pieces of bond, unlike real estate.
Absolutely. So it is correct to say that in general, bonds are for accredited investors, which means slightly larger investors. And in general, the smallest denomination of a bond you can buy is perhaps $1 million Jamaican dollars. This is true. But if you go to certain brokers and advisors, you can buy into their corporate bond portfolio. And in that way, you're buying a piece of a bond, as you just said, Delroy, rather than trying to get to that $1 million minimum target. But I do agree that the bond investment usually requires a certain minimum threshold, perhaps 100,000 Jamaican dollars, or perhaps as little as 1,000 US dollars. But
I am happy you answered that, because one of the DM thing was, when should you buy the private bonds? And the private bonds was what you just referred to, the corporate bond.
Yes, the corporate bonds. Yes. So in general, almost all of the bonds or corporate notes are in fact private. In Jamaica, we haven't really matured to the place where we have a lot of publicly listed notes. So when they are publicly listed, they tend to look like preference shares. So if you recall, JMMB issued some preference shares last year, but they were Jamaican preference shares in the region of 6 to 7%, and that was a public offering. And when you have a public offering, then you can buy much smaller quantities, even as little as $5,000 worth.
All right. Well, and let me get back to, can you get back to the comment now from, I'm not sure, from Kazam. So Kazam, there goes your answer, sir. There goes your answer. You can It is for small investors. It's just that you have to buy it in the corporate and pretty much is like listed preference shares. And because it is listed, it means that it's liquid then. You can trade it anytime.
Correct. And it trades in smaller quantities. So the preference shares, in my view, are forms of fixed income instruments, which you can buy to, which are very similar to bonds in that they are not equity. It's a fixed income type of investment where you know you're going to get a regular interest payment or dividend payment. So a preference share is, in fact, a form of fixed income instrument. And so you can find those types of investments. Some are on the public market, but not many, to be honest. Most of them are the private notes.
Guess what, Dan? There is a comment from Drake Quest to say bonds aren't a joke. The point is to have a balanced portfolio. So we have one Insta fan saying so, and we have another. And I am happy for the correction because I did not know now that it's tradable and you get it in small pieces. So Kazam, go now and you can invest in that preference share, as Dan make reference to the JMMB. So he's giving you an advice that you can get a piece of the JMMB preference shares. That's what we come to Money Matters Monday Night Show for.
Absolutely. And there are others out there. And you know, I don't want people to think that we only cater for the big man. My first in equity investment was 20,000 Jamaicans. It was 10 years ago, but it was 20,000 Jamaican dollars. That was my first equity investment. And if my memory serves me well, it was NCB stock that I bought at $15 at the time. Today that stock is down to $125, but that is still seven times what I invested. You know what I mean? So
all right. Do the right research and buy the right bonds. So hold on. So how do you decide when a bond is right? Because you have government bonds and you have the private bonds. So is there any, what's the difference? Risk, interest rate, what?
Yeah, good point. Good point. So I think once you're investing in bonds, you need to have a trusted advisor, right? You need to have your trusted, whether it's Mayberry, JMMB, NCB, BNS. I personally don't care. I'm not trying to conquer the world here. Mayberry, we have our clientele and we're quite happy. I think we manage something in the region of $40 to $50 billion of money. So I'm not trying to capture the world, but you need to have a trusted advisor. Now, you raised a good point, Deloy, because you do have sovereign bonds. You have bonds that are issued by countries. We call those sovereign bonds. And sometimes if you're not careful, you will find these high yielding bonds. And if you don't do your research, you run and go and buy them. Like there was 3, 4, 5 years ago, you had these Venezuelan bonds and you could buy them and your yield would be 14% in US dollar terms. But if you didn't understand how risky or what the reputation of that particular sovereign was with respect to paying its bonds and paying them on time, you could find yourself buying a bond that doesn't trade well. When you want to try to sell it back, everybody's afraid to buy it because they're afraid of Venezuela. And that's a real example. So when you're buying these sovereign bonds, you have to be very careful again to make sure that you're investing in countries that have a good track record with paying their debt. So even Jamaica, for instance, has US dollar denominated bonds, the Jamaican government, and they trade very well on the international market because Jamaica has a good reputation of paying its debt. And those bonds are often issued in US dollars. So you can buy Jamaican GOJ bonds in US dollars and do relatively well. But once again, those bonds tend to trade in larger denominations. You can't buy, 500 US dollars worth of a sovereign bond. Perhaps the smallest quantity you're typically going to get is 10,000 US dollars if you try to buy the bond outright. But if you have a good investment advisor or good broker like a Mayberry, Sagicor, whoever, they often will put together a portfolio of bonds. And they put together that portfolio of bonds, a mix of 10 bonds, 15 bonds, 20 bonds, and then say to you, you can buy a piece of this corporate portfolio of bonds. And in that way, you don't have exposure to just one bond. you have exposure to perhaps 10 different bonds, all packaged together neatly, where you can buy as little as 5,000 US dollars worth of those combined corporate notes or bonds. So that's a good way to go. When you're getting going for the first time, maybe you can only put together 5,000 US, 10,000 US. You go to a good broker and you say, can I buy some of your corporate notes, or can I buy into your fixed income portfolio, so that you don't have exposure to one single country or sovereign or one single company.
And that's when you will get the rates, because there's a comment that speaks about the rates are low, but I guess it has something to do with the risk appetite, because you just said the sovereign, like Venezuela. I remember years ago when I was in investment, I think Argentina bonds were they were not trading well. Let me put it that way.
Yes,
it's not that they are bad. You use the word trade well. Yes, so those were not trading well. So guys, remember, no, we're talking about you can get your bonds and you can get tradable bonds that you can buy and sell, offers liquidity, but you might get one that does not trade so well. So we wanted to understand the concept and what is behind bonds as another investment instrument. Share the live, don't be selfish, don't keep it to yourself. Only on Money Matters Mondays you get this. All right? All right. So the next question is, are they safe? Are they safe to protect the investor? I think you answered that.
Again, it varies from, from bond to bond, and that's why you need to have a trusted advisor. But I would say, yes, I mean, in the last 5 years of my trading of bonds, we have averaged for our clients in US dollar terms, somewhere between 5.50 to 9% US. So that's the range of rates that we have experienced in finding bonds for our clients. I have not had a single bond or issuer. The issuer is the person who issues the bond and is borrowing the money. I have not had a single default on any of the bonds we've issued. And I've only experienced one default in a bond that we bought, which unfortunately was the Digicel bond. So that's the only recent bond where the company came back and sort of forced the haircut on you and you lost a little money in the transaction. The Digicel bond is the only bond in the last 5 years where we like a 10% haircut. They sort of came back and forced the restructuring of the bond. It was not very pleasant, but these things happen from time to time. But for the long, by and far, we've done exceptionally well, and that's the only instance where I can think of where I've had any client who's been a bit disappointed.
So I have to counter Jody Chin, because it's a 5 to 7% returns is less than, but you are saying up to 9%. So Jody, go again, check Mayberry to see how you might can get a yield of 9%. So they are above the 7%. All right?
Well, let's put it this way. That's 5 to 7% US. I mean, JMB issued their bond in Jamaican dollars, a preference share, fixed income, pays interest monthly. And that was, if my memory serves me right, certainly like 6%, 6.35%. And they raised billions of dollars that way, like 3, 4, 5, maybe up to $6 billion. I forget the number. So $3+ billion worth of people bought a fixed income instrument from JMB for 6.35% in Jamaican dollars. And I'm offering you guys the opportunity to make between 5.5 and 9% in US dollar terms.
All right, guys, share the live with at least one person. Don't be selfish. Can you please put some of the comments in the live itself so Dan can... All right, so Dan, this one is, what is meant by bond rating? What is meant by bond rating? Rating like the person S&P.
Yeah, man. Yeah. So it's optional, but many companies, when they're going to raise funding, they're going to raise funding in the form of a corporate note or a bond. They may choose to have the bond itself rated, or the company itself may choose to be rated, similar to how countries are rated. And that rating, for instance, in the Caribbean, Carrie Chris does the ratings, that rating will help build confidence in the company and therefore help the broker or somebody like a Mayberry in pricing it ultimately. So when we go to raise money for certain clients, if we have doubts about them or they're not very well known to the market, we will encourage them to go out and get themselves rated by an independent rating agency. And that rating will give sort of independent assurance as to the financial health of the issuer, i.e. the company that's trying to raise the funds.
Welcome, Superfit Samson. Yes, man. Welcome, Shaku Don. Yes, all right. So in the Caribbean, Carrie Chris is pretty much the same like the S&P to the rest of the US and stuff. Okay. All right. So you see it? That is what is meant by bonds rating. So the rating will decide how risky it is and stuff like that. All right. No, we answered this one already, that that you can have a secondary market to sell your bonds. If you don't want to, if I don't want to hold to maturity, what do I do?
Yeah, so again, I kind of mentioned there are two ways to get into it. One is to buy in corporate portfolio, so you don't own the bond outright yourself, but you sort of own a participation in the bond. And in that case, when you want to sell the bond, broker himself, your investment banker, is a bit of a market maker. So they sell you the bond and they buy it back from you. So that's one way to do it. The bonds, the private bonds, as we said, can only be sold to accredited investors. So it's sort of sold in a private marketplace. When you buy the bond outright yourself, you therefore have to depend on your broker to sell the bond for you. So in the same way, when you bought the bond, you had to buy it through a broker. When you're ready to sell your bond, you have to sell it back through your broker. And usually, once it's a good bond, it can be sold within 5 to 7 working days. It's not a big deal to move a good bond. There are always people looking for good notes to buy or good bonds to buy, and quite often people who have them aren't selling them, especially when they have a good yielding US dollar instrument. Very hard to get them to buy these days.
So who is the accredited investor? You made mention of the accredited investor.
Yeah, so in order to buy a bond outright yourself, you have to qualify as a accredited investor. So what's going on? The big difference between a bond raise and an equity raise is a public equity raise, which we call an IPO. You have to prepare a prospectus and get it fully approved by the FSC and the JSC. That prospectus, you tell them the world, and it's going to be probably a 100-page document where you show them everything and you convince the regulators that you're going to be selling this to smaller people and smaller quantities, and therefore the bar that you have to jump is very high. Now, when a company chooses to do a private raise, a private bond raise, you go to the FSC and say, I'm only selling this in large denominations, the smallest denomination being 1 million Jamaican dollars, and only highly qualified, sophisticated, wealthy persons can buy it who are deemed to be smarter. And in that case, we don't have to prepare a 100-page prospectus. We can prepare a 20-page information memorandum. These are smart investors. They understand risk a little bit better, and therefore we're only going to be selling to them and not selling to the wider public. So clients like Mayberry, we typically only deal with accredited investors, right? So Mayberry is a small firm. We only have 6,000 customers. We're not trying to have 10,000. We're not trying to have 50 branches. So it is true, we tend to focus on accredited investors, and to open an account with Mayberry, you must have at least that $1 million minimum amount. So it is true that we focus on the accredited investors. And so bonds usually only trade through accredited investors. You can't buy it open stock exchange or on the open market. You must be an accredited investor.
And I just said there can be smaller purchase through the funds and stuff like that. You can still participate in smaller blocks. So you, if you are not accredited, you don't have that $1 million, you can still partake in bonds. And bonds is another type of vehicle, investment vehicle, that help to protect and preserve your wealth. Tonight we are with Dan Theoc, Senior Vice President, Investment Banking at Mayberry. No joke. Share the live. We have a few minutes to go. There is one.
Hello, I did want to again reiterate to Jody Chin's point. The 5 to 7% is U.S., not Jamaican. So Jamaican inflation has averaged, 5 to 7%. That's Jamaican. When you invest in U.S. dollars, you sort of are already protected from Jamaican inflation because the exchange rate is generally moving above inflation. Then you are on top of that, earning this interest. So you
have double protection.
Absolutely.
You have double protection.
Absolutely. So when you earn 6% Jamaican, you're barely beating inflation. When you earn 6% US, you're way ahead of inflation.
All right. And lesson to note. There is one last one we're going to take, and this one says the BOJ signal the rate, a rate increase. How will that affect my bond?
Right. So that remains to be seen because the BOJ rate really deals with short-term interest rates, overnight call rates, and it's usually gobbled up by the commercial banks. So what's happening here is the overnight call rate has increased by 1 percentage point, and for commercial banks who are long and cash have excess liquidity, they're typically investing this money in the BOJ for the very short term. 30 days, 60 days, 90 days, maybe up to 12 months maximum, right? The corporate notes and bonds that we're talking about are usually medium term to longer term. They're usually a 3-year note or a 5-year or a 7-year note. And so I don't think it's going to impact it significantly. And it certainly won't impact the US dollar bonds, which are the ones I'm sort of encouraging young investors to focus more on, the US dollar fixed income. So
all right, we will not forget this.
Sovereign change won't impact that.
Well, you got back Jody on your side. It is, in that case, it is not too bad. All right, we're happy. We're happy that it was cleared because it's US dollar rate that is talking about. So we said we're on top of the 9 o'clock. Yes. Dan, is there any parting words? Because I'm telling you, I did not know bond was so. It's like, oh, James Bond is exciting. That's the word bond. Bond. Yep. It's really alive.
Yep. Again, you want to invest in Jamaica Stock Exchange when you can and you're comfortable with Jamaican dollars. And other than that, you flip to US and try to get yourself some fixed income instruments. And I think for the younger investors, you want to push hard on the equities. I would try to have 60% of my portfolio in equities and the other 40% in US dollars, and then look for good fixed income instruments in US dollars. And as you mature, ultimately, obviously, you want to try to get a little bit of real estate into the mix as well, too.
And one takeaway I have, find a trusted investment advisor. Any plans to create a crypto ETF and offer to your clients? Just curious. Well, I leave that with you. I have no comment.
Yes, not right now. We love Jamaican equities and the US bonds. That's our love right now, and I'm sharing the love.
Well, Dan, thanks for coming again on another Money Matters Monday show. We truly appreciate the knowledge shared. And guys, follow Dan, follow Money Matters, flip over to YouTube, follow the Mayberry page. You can't go wrong. They have seminars, they have investor forum. Follow Mayberry. Can't go wrong.
I appreciate it.
Thank you, Dan. Thank you guys for tuning in.
All right, guys, all the best.
All right.
Bye-bye.